When should you roll your own? How would you do it? When's it going to break? And when you should just use a third-party product?
I think that everyone should try rolling their own. That might be a contrarian take, but I think that...
You're so sneaky.
It's not venture capital, it's private equity. It's the Private Equity Fundcast. Pour yourself a drink and have a seat.
Do you actually know your exposure? Do you actually know what you own? And do you actually know how it's performing? Today's conversation is going to be about portfolio monitoring and whether you should roll your own or not. And I think you're going to be surprised with the answer that my guest, Kevin Hsu, the co-founder and CEO of Lumonic, has to say about that. So let's dive in.
Thanks for having me on the show. We got started about 3 years ago, really as a venture-backed kind of bootstrapped company. Before that, I always like to say I've really built my career starting at a company called Carta, which
I think most of our listeners know Carta and know it well.
Yep.
So for the people who don't, what was Carta and kind of what was the spark for you to say, there's some other version of this I could do on my own?
Totally, yeah. So I joined Carta because all my smartest friends from college literally moved to San Francisco and joined this company at the time called eShares. Carta is a cap table management platform. And so the way to think about it is historically you track a cap table, which is who owns what, debt, equity, options inside of spreadsheets. Carta literally put it on the internet. I think a lot of SaaS can be boiled down to literally putting numbers on the internet. This is an internal meme that we have at Lumonic. But really what it's doing, and I think the kind of arc of my career is started at Carta, worked on cap tables on the product side. Carta became so many different things. I think one of the beautiful things about Carta is that it spun into all these different ideas, just starting with this atomic unit of who owns what. So now they have a fund administration business, they have an LP business, and they're the biggest cap table platform in the world for any private company. From there, I actually started another portfolio management company. So I'm on number 2 right now, called Standard Metrics. So that was a portfolio management platform focused on venture capital firms. In the name, you can kind of see this thesis building up, which is the private markets doesn't really have any standardization or lingua franca.
This is all sitting in version, F22, version final, actually final spreadsheet somewhere, and the associate who worked on it, you don't have access to the folder he left it in. So you want it somewhere everybody can get it. You have one source of truth.
Yeah, exactly. And that was focused on venture. And left there, took a couple months off, literally spent time in a cabin doing some writing, thinking about the next thing. And I got really interested in banking. Specifically, there's a book by, I think his name is Jeff Wang.
That is some 2 months in the woods that you got so bored that you read that book.
I still find the central banking system incredibly fascinating. That actually led me towards looking at debt. Ended up spending a lot of time with this author named David Graeber, who wrote Debt, the First 5,000 Years. I'll send you a copy. You don't have one.
I would love it.
That book actually got me thinking probably too philosophical about debt. But that led me into starting to think about starting another company, specifically building within banking. And so our story is around January 2023, I wanted to work on the next thing and had a co-founder at that time. So it was just 2 of us. And we started spending time with people who worked at banks. And so Silicon Valley Bank, and the timestamp here is important because January 2023, Silicon Valley Bank, we ended up spending time with their kind of customer-facing team, and then we ended up spending time with their venture debt team. And that's where we first stumbled on this problem that we solve today, which is you have a bunch of data coming in if you're a fund manager, and in this case, it was a bank. Specifically with venture debt, what was interesting is that it was compliance-driven. So you had to do this thing called the compliance certificate. I'll never forget the first time I ever saw that inside of one of these discovery calls, realizing, wow, there's this crazy document that gets signed every single month. You have to do it. There's no software for it. And
it's sitting in DocuSigns and PDFs and email attachments all over the place.
Yeah.
And whether somebody remembered to save it down to the right file folder somewhere and name it the right thing, that's the way you find it.
Exactly.
Yeah.
And so one thing led to another, and we decided by February, and I'm using the specific timestamp.
Oh, I know exactly where you're headed.
Yeah. By February, we were like, okay, banks seem like they're going to be kind of hard to sell into. We're literally two guys in my apartment in San Francisco. And I think the question that started Lumonic was, is there anyone else that does lending like this that isn't a bank? And so non-bank lending, private credit. So we found that pretty early. By March of 2023, we incorporated the company. We had started talking to our earliest customers like Hercules Capital, Trinity Capital, Triple Point, all BDCs, all venture debt funds. And I'll never forget this. We flew out to one of our customers' houses because they basically said, this is a problem that I care about. I can't send you anything over email. You can come over to my house. And we said, how about this weekend? So we flew to San Diego.
You can like lean over my shoulder and I can show you my screen, but I can't send you any of this.
Yeah. And that customer ended up becoming customer number 4 or 5. I won't share the firm name because, at the time it was a little risky. In March, obviously SVB goes down. At that moment, one of my favorite anecdotes is that we had asked a lot of these funds, surely someone's tried to sell you software. And my favorite anecdote is that, this MD at a private credit fund said, what would software do? So that was a light bulb moment for us. Yep. We decided, okay, private credit seems like it's growing. Again, 3 years ago, I still think it was kind of on the back burner, but we got really lucky, caught the tiger by the tail.
Oh, this is at a time when private credit assets are going from the hundreds of billions into the trillions, right? So not bad timing, which is great. Tailwind for you.
Yep. So we raised our institutional round from first round capital.
Yep.
Your office reminds me a lot of their taste and style, which is why I think I like it so much.
Not an accident.
Yeah.
Our marketing and media strategy.
Yep.
Not dissimilar.
Yep. Keep in mind, 2023, it was pretty hard to fundraise if you weren't doing anything AI related. I think ChatGPT had launched.
Oh, just remember, June of 2022 was the SaaS-pocalypse before the current SaaS-pocalypse. And basically, software is dead, SaaS is dead. It became a pretty big theme.
Yeah. But we were sitting, again, I don't want to claim that we're the smartest guys in the room, right place, right time. And then there's this idea of founder market fit that I think we had really strong between my co-founders and I. My co-founders were early engineers at Carta. I was on the product side. And here we were sitting with private credit as an asset class that had no software. We had experience building portfolio management software at not only my previous company, but then also at Carta. And one of the dirty little secrets about working at Carta is that Carta is a cap table management platform focused on equity. I personally worked on the debt tracking, and I remember it was a part of the product no one ever wanted to touch. So no one really understood credit, debt. I didn't know what it was.
We've looked at Carta a few times. This may be dated as a private equity firm, and just the way we own and the structures we have and the debt we have, we understood cap table management, but the private equity side of it was lacking in our opinion.
Yeah.
And they're not a private equity platform. I mean, venture is where they really shine. But I would say we looked at Carta and it was like, it's great for venture, but not for us.
100%. And so I think that kind of segues into our thesis as a product roadmap and strategy, which is we started in private credit, but we realized very quickly private credit's probably one of the hardest asset classes to build monitoring for. If we can crack private credit, I think 6 months into building the product in the company, we realized this product might work for private equity. This product might work for venture. Although each of those markets were kind of afterthoughts for us, but we architected the product. And my co-founder, Andrew, deserves all the credit on this. We have this idea of building in a primitive-based way. It's a very specific way of building. Say the closest company that builds products like us is probably Rippling. The idea there, Parker Conrad, who's a founder I'm a big fan of, has this idea of a compound startup where effectively, if you can figure out what all the primitives are for whatever market you're going after, when you enter into new markets, you just use those same set of primitives. So an example of a primitive for Lumonic would be, if you looked into our database, you'd notice that we don't have a metric, we don't have financials, we have things that are abstracted to things called properties. And that's really nice because on the front end, if a customer interacts with our product, if they're a private credit firm, we turn it on, we label it covenants. And then for private equity, we call it whatever we want in the back end. So it's this really kind of elegant solution that my co-founder really drove on in terms of architecting the platform.
What's unique about private credit? What made it tough to crack, or the attributes that we were like, if we could do this, everything downstream of that is easier.
Yeah. So by definition, every deal within private credit in a portfolio is different. Every borrower has a different set of covenants. Every borrower, their financials are still super messy, but they have just bespoke deals. And so building a platform that can account for all these individual things that you want to track across borrowers, but then also being able to roll that up into a global view to look at your entire portfolio. Let's say you're a private credit fund manager across 50 to 200 positions. That's just fundamentally really hard. If you think about, I'll just don't want to pick on Carta, but Carta is really trying to impose standards on how a cap table is tracked, right? Lumonic is almost
that's where it broke down for us.
Yeah.
Which was like, hey, again, in venture, it's like, hey, we all own common equity, or we all own some convertible preferred, a safe or something like that.
Yeah.
For us, I mean, we're a buyout investor.
Yeah.
Most of our deals are structured pretty similarly, but there's nuance and changes where sometimes we need it to, like, inside a cap table to have different structures and different tranches and layers.
Exactly.
Which gets a little more difficult on the buyout side.
Exactly. And so our thesis, and I think it ended up becoming true, is if you can get the right primitives down, and this is a very Lumonic word, but if you can, basically it's the Lego blocks. If you can figure out down to the studs, what are the primitives that would work in private credit, you could probably reassemble those into other asset classes. Yep. This year, we've signed more private equity and venture capital firms than we have under our platform than private credit.
So I want to tell a few stories, right? And I know you've sat in on like investment committee meetings and kind of deal meetings with private credit funds and others just to get a sense of kind of how things work. So let me tell a couple stories and then you can jump in with your own of what you've seen. I was just with Kunal, the CEO of Morningstar, last night, and you and a bunch of private credit people. And his first job in 1997 at Morningstar, where my two brothers started their careers, several years before that here in Chicago. His first job was to go into the fax room, take financials and metrics and other things from mutual funds off a fax machine, and then type them into, whatever Access database or whatever it was that the Morningstar was using at that time. I'm sure it was more than Access, but maybe not much more. And then my wife's job when I went to business school was she got a job with the endowment of the university I was at because she had been working in investment banking alongside me. And she went to them and said, like, this is in summer of 98, like things were blowing and going and checks were just showing up from everywhere. And they were kind of like not exactly sure we got a check from Sequoia, but what was it tied to? What did we pay for it? So she literally just took what, today would be PDFs, but then were just mailed quarterly statements, mostly in the venture portfolio and the buyout portfolio later on, and just typed in, this fund we're in, we have this much money, they own these 30 companies. She went and did research. This is a software business in healthcare. This is a telecom business. And she would just tagged them basically. And it took all of 2 years to go through and do that manually. My prediction is we will look back 10 years, 5, 10, you tell me what time frame from today, and the stories I just told will feel the same as 10 years from now when people look back and say, like, we did it that way?
Yeah.
Like, you actually got a PDF from Intralinks?
Yeah.
And then I would say probably did nothing with it, for most LPs, or just reference it somewhere. So what's your story of sitting in these meetings of how data is getting handled on the portfolio monitoring side at the GP, at the LP level, and even down, upstream and downstream from that?
Yeah, so it's a privilege that I've gotten to basically be able to sit in on our customers' portfolio review meetings. And you might be wondering, why would I join these? So what Lumonic does is effectively...
Why would you join them? Because I assume you're a really good product manager, and product managers are basically anthropologists, the best ones.
Yeah.
They're super curious anthropologists.
Yeah.
Like, how do I build a product for you if I don't sit in and watch you actually in your natural environment?
Yeah.
Right?
Yeah.
So that's why I think you were sitting in them. Good for your customers for letting you sit in on it.
I know. And they're really confidential meetings too, right? Like, people kind of let loose, and you really understand an organization's structure and hierarchy inside of these meetings. Our data powers those meetings. And so I think for me, seeing it firsthand to say, okay, interesting. It's interesting that one of the takeaways was that a lot of the data credit and private equity firms look at is usually retroactive. And so portfolio review, I think, as a concept is actually pretty interesting because it's like you're looking back at data.
Dude, it happens a month at the earliest after the end of the quarter. So you're looking at 120 days ago, because it takes you a month to kind of get the books closed, get the meeting set. It's probably 6 weeks after the end of the quarter.
Yeah.
We already have almost halfway through the next quarter before even looking at the last quarter.
Yeah.
I mean, that's us, and we only own 12 companies.
Yeah.
So it's not that hard.
Yeah.
But it still is like, okay, when are we going to do this? How are we going to do this? How do we pull it all together? And Cass on my team, who you guys have met, she pulls it all together with some help of the associates.
Yeah.
And we've been, how do we automate this? How do we automate this? And we can talk about that later. But I mean, it's a constant thing of like, is this worth automating or not, given how many companies we have and the complexity or lack of complexity? So, all right, so you're sitting in portfolio reviews of much, much bigger organizations with hundreds of positions across, dozens of private credit funds. So what was the common theme you're hearing in the frustration?
Yeah, well, I think one, data is outdated, and you're making these decisions. I think number two, it's usually more of a review than it is any kind of action-based meeting, right? So people are saying, hey, what's the risk rating on these specific deals? Okay, maybe make it a little higher. What are the marks? A lot of that meeting feels very passive. I think that was most surprising to me, where when I think about portfolio monitoring or portfolio management, it feels like it needs to be way more real time. It feels like you should have fresh data. And this is kind of what we do, but it feels like it should be more timely. There's a bunch of reasons that we can unpack as to like why that is and how the market ended up shaping this way, like structurally. But I think that's the biggest takeaway for me. It's a very retroactive, passive meeting, whereas it feels like the future of a portfolio review meeting should actually be, you should have all the tools to be able to re-underwrite on the spot. Right? You should have all your inception numbers. You should have all your actuals. And if you did want to re-underwrite that deal as of today, what would you do?
This is a bigger conversation, but let's have it.
Yeah.
Which is public-private convergence. Obviously, Morningstar, which we haven't mentioned, you're now part of PitchBook, which is part of Morningstar. So you now have visibility into all that with all that data. But Kunal and Nizar and you now, conversations we're having is public and privates are going to converge.
Yeah.
They already are.
Yeah.
It's going to happen whether we like it or not. And the plumbing is behind the money. The momentum's way ahead of the plumbing and the infrastructure to track it. I think we're going to get to daily closes at our portfolio companies in the near future.
Yeah.
That means if you're at a daily close, you could do daily valuation. Walk me through that vision of where we're headed, and then we'll jump in and kind of talk about where we are now.
I feel like I've spent most of my career building specifically just boring, unsexy infrastructure, putting numbers on the cloud or on the internet, making it easier to get data in and data out. One observation is that today the paradigm is you have public and private companies. But it feels like, and I think right now is a really good moment because of OpenAI, Anthropic, these really large private companies about to go public, where it's always felt like there's this in-between stage of a company. And so this isn't one of my original ideas. There's this guy named Manu Kumar who actually co-founded Carta with Henry. He has a firm called Canine Ventures, but he has this thesis that he wrote probably 4 or 5 years ago of a privately traded company. So it's this in-between layer that it feels like it should exist, where when you look at Anthropic or OpenAI, I think they probably have reasons on why they need to go public, but there are, I'd say, a huge cohort of private companies now where, the only thing really different about them is they don't have liquidity or, reporting standards. But it doesn't quite feel like a lot of founders today want to go public. There's not really good reasons unless there's a huge capital demand or
Stripe may be the perfect example of this, right? The company that everybody thinks should be public because of, one, it's got great leadership and they brought technology to an industry that didn't have a lot of technology. It's raised gobs of money and they've done tons of secondaries, and there's appears to be quite good liquidity for the investors there. So if liquidity is the reason to go public? If you have liquidity, why do you care?
Exactly. And I think another angle on it is that, my mom can't invest in Stripe. I'm a huge fan of Stripe, have a ton of friends at Stripe, but I think that's really the reason. But if you're the founder, Patrick Collison or John Collison, Kevin's mom wanting to invest in Stripe isn't a good reason to go public. So why would you?
Totally. But she could go to Setter Capital or some other place and buy some employees' shares at some price that, gets privately negotiated.
Yeah. And so we're touching on another thing, which is I just think the secondary markets within any kind of privates is just really interesting. There's a lot of activity happening across private credit, private equity, continuation funds. That's a whole thing, probably a separate podcast, but
which requires
infrastructure,
plumbing, transparency, consistency, a gap style agreement on like, hey, what are these things worth? Privates get to pick what things are worth, right? In the private credit market, a little less, arbitrary because, public companies are marking things to market, and that reflects what the equity might be worth if a big public provider is marking it down or marking it up or something like that.
Yeah.
So this is the challenge. This is why I think 10 years from now, we're going to look back on that story that I told about my wife and Kunal, and going to be like, we did it. What do you mean you waited 6 weeks to put a PowerPoint together to walk through your team and show 100 companies 100 different ways?
Yeah.
Right?
Yeah.
With 100 different metrics that matter.
Yeah.
With we're already deep into the next quarter, so there's nothing we can do about that now. What can we do in the short time we have before this quarter's over?
Yeah.
All right, so let's talk about who's the buyer. Like you and I have had this conversation as a startup CEO trying to find product market fit. Is there an obvious person you're calling inside these firms who's like, oh yeah, I'm in charge of that?
Yeah.
Because I think the person in charge of it at ParkerGale has probably changed 4 times in the last 12 years.
Yeah.
So good luck trying to find the person here who's in charge of it now.
Right.
And that might change. So who is the buyer?
The buyer's the person that's going to pick up the phone and cares about the issue. I think if there's anything I've learned selling, meeting customers in this space, it's that you can kind of bifurcate it by saying you have the front, the middle, the back office. And the product we sell really is post-investment. And usually it's someone in the middle or back office. So usually titles are like CFO, COO. But if you were to look at our customer base and the buyer for all of our customers, it's not consistent at all. This is the number one thing I tell new salespeople that join.
So that's
us.
a sales challenge. Is like there's pain.
Yeah.
Well, is this we would say, and you've heard this before? Is this a painkiller or a vitamin? Your product.
Yeah. I think it's a painkiller for very specific, if you fit this criteria, which is your portfolio is growing. Usually what we see is we do have firms that'll start, they'll close a new fund and they'll get usually PitchBook, and then they'll right away want a portfolio monitoring solution. And usually it's because at a previous life, they had a portfolio where they just couldn't really see what was in the ground. So usually our magic number is 15 to 20 portfolio companies.
Yeah.
And then 2, this is really hyper specific. But if there's been any kind of workouts or events in the portfolio where it would have been really nice to have numbers since inception, what did we think we underwrote this to, the plan, everything in a central place. That's usually like the best case scenario. We had a customer sign up with us this year where we'd been talking to them for probably 2 years, and they only came back to us because they had a covenant default. And long story short, they didn't know about it until maybe 45 days later. Head of the firm said, what was that tool that literally would have prevented this from happening? And they came back and said, give us a contract.
And the reason your tool would have prevented it because you're pulling in data every month and you have the credit agreement sucked into that thing and it's automating tracking against the metrics you're pulling in.
Yeah.
Right. So it would have triggered it literally the day you got the financials.
Yeah.
And in my scenario of that we get to daily closes, you wouldn't have to wait till the 20th day of the following month to know that when the books were closed. You would have seen yourself headed towards a covenant default within the month you defaulted.
Exactly.
Yeah.
Exactly.
Yeah. So let's talk about what's happening now.
Yeah.
So what are people tracking? Taking a PDF and typing it all in, that's hard.
Yeah.
So there's friction there.
Yeah.
Automating everything off of a report from one of your portfolio companies sounds amazing, but in actuality, I don't think many people are doing that. And then you've got AI and MCP servers and all these other things. So where's most of the industry now?
Yeah.
And then what does good look like today?
Yeah. So I look at our CRM analytics every week. And the specific thing I look at is of the private credit funds that we've met with, what percentage are on spreadsheets? That number is 60% as of last week.
So not using a software tool at all, just through spreadsheets.
Yeah.
60%.
60, whereas
of a $3 trillion market.
Yeah.
Okay.
3 years ago, that number was 80, closer to 80. Private equity is actually pretty different. This might actually surprise people, but it's closer to 40% are in spreadsheets. And then in venture, I think venture is probably the most saturated. You'll meet, most firms have some kind of tooling. One other thing that's pretty unique about venture is that because by nature of their investments, they're spending a lot of time with founders. Most of the venture firms are pretty AI pilled, and so they're building something on their own. Some analysts can just spin up a app to do some of this stuff and vibe code it. And so penetration, I would say, of software specifically for monitoring is actually quite high in venture.
This is monitoring the financial performance of your underlying portfolio,
That's right.
And then in credit, the covenants and other requirements to stay compliant.
That's right. And then in private equity,
Venture guys, they don't have financials. What are they tracking?
well-
I can see them tracking the cap table to say like, oh, this is how much we own at this valuation. But like, are they really? They don't do any diligence. What do they need to track financials for? I'm just giving you a hard time. So all right. So we got 60% of private credits on spreadsheets.
Yeah.
40% of private equity still on spreadsheets using some sort of portfolio monitoring tool. We've built our own, used a third party. And now we're thinking about building our own or using yours.
Yeah.
So it's good timing. So, I mean, this is just in the last 12 years.
Yeah.
We've gone through this. And you'll talk me out of building our own, but we'll do that after the pod. This is probably obvious, but what are people tracking? Is it just, are we tracking the whole thing? Balance sheet, cash flow,
Yeah.
full P&L, or are we tracking just the major metrics?
No, yeah. So I'll give you an analogy, maybe two here. So effectively, all Lumonic is we're a ledger. And I'll use, for the audience, mainly being private equity, private credit people, think about it in accounting terms. And so all a accounting tool is a ledger, and then you create different cuts of that data, which are your financial statements. So you have your P&L, your cash flow statement, your balance sheet. That's all Lumonic is. We're a ledger that stores all your financial metrics, your qualitative metrics. And so on the private equity side, this would be if you have value creation KPIs that you set at underwrite. These are the things that you're tracking in a time series way.
We're going to drive margin from X to Y. We're going to, go from this retention to that retention, something that wouldn't necessarily, not everything would show up in a P&L.
Yeah.
Okay.
And so KPIs are actually a lot more of the drivers. There's pro forma financials. Some of these companies are really acquisitive. On the credit side, it's all the financials. And it's also things like covenants, compliance certificates, loan tapes. I think the interesting way to think about Lumonic is if you use this analogy of a ledger, we're effectively, we have different forms of things that it powers. So one specific use case and set of metrics is valuations. So Lumonic data is used for valuation. So there's probably a standard set of 25 to 30 metrics that any private equity or any private credit fund should be tracking, because if you use a third-party valuation firm, they're going to ask for those. We'll preset those for you and get them out.
Wait a second. So I don't have to send an email to the associates of the firm and say,
Yeah.
hey guys, Kroll showed up, or now Duff and Phelps Kroll, whatever one they are. They're here again this year. Start pulling everything from from the file server and get them all the financials they need. You could just say like, here it is.
Exactly.
Okay.
And what the valuation firms and even the auditors, right? Auditors are another use case. What they all want is they want traceability down to the source file, and that's literally what our software does on the front end. You drop in files, we ingest the values from it, and then we show you an easy way to be able to get down to the source file.
So if you click on something, it'll say this is where it came from.
Exactly. The second probably bucket from the ledger that people use data for is portfolio review. So we just talked about this. On a quarterly, if not monthly basis, I'd make the case that you probably should have some ritual as a private equity firm or private credit firm where you're looking at the portfolio, and you're ranking it, right? So I think having that meeting is one thing. Looking at the data is another thing. Having some kind of framework. This is probably the most interesting piece that I get to see, but I can't really talk about in terms of what firms do. But everyone has a different way of assessing risk, right? By asset classes is different. Most firms have a proprietary risk rating on the credit side, where it's a number system, it's a letter system, and how those numbers get determined can be really quantitative or really not. And so portfolio review, and we'll power those artifacts. It's sometimes pretty visually dense, but we have ways that we can make it more visual. The last piece is for LP reporting. So, pretty standard for us is customers will come to us after they've implemented our software to say, hey, we have AGM coming up. I want to tell a specific story about our portfolio. How many jobs does our portfolio companies create a year, right? Interesting insights that are not just how are the companies performing, but it's like you have a firm, you have a thesis, you have a narrative that you want to tell, and a lot of the data that you collect on Lumonic can actually tell that story. One of the interesting things that I've always thought we should do during implementation is we should pretty deeply embed ourselves into the firm's strategy, look at their past AGMs, look at their past fundraising, and say, okay, because those are the outputs that you care about, we need to start collecting that data now. So that's one. And then on a quarterly basis, there's usually LP reporting that we can power.
Yeah, as you're talking, I'm thinking through exactly where we do these things. So the first Monday of every month, Paul Stancic comes in, who runs go-to-market for us, basically reports on bookings for every company. And this is before we've closed the books, because we know what the bookings are, the last day of the month. And it says booking is against budget. And bookings go over some period of time. Now he's literally pulling those from a weekly spreadsheet he gets. We have our mantra is more, less data more often.
Yes.
Which is like, I only need these things, but I need it every Monday. So that comes in a spreadsheet. He then goes and grabs all those spreadsheets and then puts this little, it's a 20-minute conversation in the Monday meeting, the first Monday of every month. Yeah. Unless all the numbers are red, and then it's maybe an hour and 20-minute conversation. Yeah. But we do that. Every quarter, we do the portfolio review. Every quarter, obviously, we do we don't do a monthly portfolio review, though I guess if we had more data and easily accessible, we could and would. And then portfolio reporting, and then AGM, which is, again, our stuff's all in spreadsheets right now. Again, we had a tool. We were manhandling it to get it the way we wanted it. It was much more for value creation tracking than financial tracking. We would like both, but if we wanted to lean on one, financial tracking more important to us than value creation tracking. And then I would love to get to a place where I'm not sending a PDF over intralinks to my LPs. Yeah. And we have you see you're in our office. It's a very pretty office, visually appealing. Our quarterly report is visually very appealing. Yeah. On purpose. Lots of charts and graphs. It looks pretty. There's a lot of information, and we have used visualization to make it obvious what's working and what's not working. But I envision a time where I'm sending them a link, and they're going to some HTML, some website that Claude code and an MCP server tied into a back-end product like yours is basically like, go click on stuff, play around with it, change time frames, change whatever you want to do. Like, here it is. Manipulate it. And that just makes the commentary up front that I would make, one, either maybe unnecessary, and two, just like, again, transparency, public-private convergence. You can do this. You can go in PitchBook or FactSet or whatever, or Morningstar, and find all the public company stuff you want. Yeah. We're headed here. Yeah. We're headed here, and the thinking that that's not going to be a requirement, that you can't just give a flat file, PDF to a large financial institution or a retail investor and say, like, here's what I think. It's like, no, show me what is true, right? Yeah,
this it's kind of a thought-provoking question, but I've always thought, because I've spent a lot of time with family offices, some of these endowment funds, the LPs at the end of the day, they probably love the PDF you send them, and they probably appreciate that it's thoughtful, but they also just want a raw data dump of all the data, because that's what they're doing on their end. Yeah. They have all these fund managers, and they're extracting. They're doing the same process on top of the data one more time.
And then go fundraise, and every LP sends you a different DDQ requirement, which is like, all right, give me your numbers this way, give me your numbers that way, so they can decide, well, what's the issue? Were all your returns from multiple expansion and debt paid and leverage, right? Or was it from value creation of like making the business better? Was it from growth? Was it from growing margins, expanding EBITDA? Was it from leverage? Was it from market? And they want to know, and they will build a graph. Basically says, hey, ParkerGale generates most of the returns from X. Yeah. And I'm like, no, it was Y. Yeah. So look at it, like, no, look at the data. Yeah. And then because I'm giving 25 different LPs or 125 different LPs, different cuts of the data based on their format. It's like, no, here it all is. Have fun with it. That sounds like a kind of better way to do things.
Yeah, it comes back to infrastructure.
Now, there's no standard way of an LP wants to see it. And they want to say, they call it like the portfolio workbook or whatever they call it, or the value creation matrix or something. And it's like, no, here's everything. Have fun with it. It's all audited, and you can go auditable in terms of you click on something, it'll pull up the document. Yeah. What's the edge case, though? Where does it break I'm thinking of like, I'm doing add-ons, I'm restating things, I've got add backs. We brought in a new CFO and he decided to define gross margin in a different way because we put customer success up in COGS instead of down in sales and marketing or onboarding or whatever it was. So gross margin went from 75% to 68%. I was like, no, that was just a reclassification.
Yeah.
And I'm not going to go back all the way 6 year and restate the whole thing. Like, where do the edge cases that you're like, guys, I'm solving 99% of your problem. Let's not spend all our time on the edge case. But where do current systems start to struggle a little bit?
It's a good question. Yeah. That exact scenario that you just painted is I'd say if your portfolio monitoring solution doesn't handle that and automatically tells you there's a reclassification and the numbers, you can choose exactly down to the period when you want to restate it. Like if it doesn't do that, that's table stakes. Like any portfolio monitoring solution should be able to do that. I think where the edge cases are today, or we're probably in Act 2 of, call it private market infrastructure software companies. And again, I've spent a lot of time studying this space, built in this space. I think Act 1 was effectively putting numbers into a website.
My wife and Kunal were doing in
exactly.
or in the late 90s, which is I'm going to take something that's in a physical form and put it in a digital form.
Act 2 is probably where we're in now, which is you had a bunch of companies innovate on how to get data in. So, and I think with the AI kind of wave here, it really has impacted this space in a good way. But effectively, you have all this messy data and you need to transform it and move it into a standardized format to then be able to tell stories from it, make decisions off of it. If I were to guess where Act 3 is, I think it's being able to blend data from different sources, right? So as a private equity fund, you have probably 3 core systems. 1, your CRM, 2, some kind of portfolio management platform, and then 3, you probably have a general ledger that your fund admin uses.
Yeah, we use NetSuite.
Yeah. And none of those systems talk to each other.
None of them.
And so you have this massive entity resolution problem, which is what is a deal that started in Affinity or Deal Cloud that then ended up in Lumonic that we tracked and had all of our financials with, and then the fund admins are booking and the schedule of investments down to the journal entry, and no one's actually tied any of that together. And I think Act 3 and where we spend a lot of time thinking is how do we actually become the database that blends it all together. One way you could go about it is you could build 3 different companies. Or 2, you can figure out this kind of interesting way to be able to transform data in a more generalized way. This is why you see a lot of firms. I think one of the emergent trends right now is a lot of firms will actually have a Snowflake or some kind of data warehouse where they basically pool all the data, and Lumonic being one of those sources, CRM, fund admin, and then they're effectively doing transformations to actually do that unification. But that's not a product. That's a data engineer and a data warehouse.
Oh, that's an IT team inside your firm that, likely has high turnover would be my guess. Because once you kind of build it, it's like, it was fun to build it, but then to just monitor it's not that exciting.
Exactly.
And you're like the one dude inside the firm who knows about this stuff and you can't talk to anybody.
Yeah.
Most engineers want to be around other engineers doing cool stuff, would be my guess. What have you been impressed by clients or prospects doing?
It's actually pretty barbelled. So this might be surprising, but a lot of the most innovative stuff I've seen personally is actually with these smaller emerging funds. And they do it out of necessity, right? I think
because every minute spent monitoring the portfolio is a minute not spent sourcing the next deal.
Exactly. And so they need an edge somewhere. And so some firms have opted to say, well, we're going to just be we're going to be a 2-person shop. Or maybe 3, and one person is just the technology person is going to help us make it so that we don't need a large middle or back office.
Yep.
And these are doing things like building, if you're a credit fund, building a website that basically captures leads. But once that lead information gets captured, that gets pushed into tools like Clay, where then it gets enriched from data from PitchBook. And I'm talking about a whole data pipeline here that you could build today.
Oh, we call it the perpetual lead machine.
Yeah.
We've built it in Clay and we spread it out across the portfolio.
You guys use Clay?
Yes.
Amazing. Okay, so we use, we got to talk after this. So
just watch out for your enrichment costs. Don't enrich don't enrich a list that you haven't scrubbed. Because you're paying for leads you don't need the 100%. Enrichment for. Yeah. Anyway, we can get into that.
Yeah. I mean, Clay's
it's like the in-app purchases, like on my PlayStation. It's like, why did I spend so much on PlayStation? Oh yeah, because I was buying stuff in the middle of the game.
Yeah. And so that whole pipeline, I'm basically deciding, hey, should we spend more time on this deal or not? You can pretty much automate. And again, the smaller firms are doing that. And then I think even cooler is like, when can you actually use data as an asset? So in your Clay table, great, we can hook up Lumonic as a column there, and so that's a very specific Clay reference. But this company that we're evaluating or underwriting, what is it closest to in our portfolio based off performance? Let's say you've been using Lumonic since the inception of the firm. You actually have this benchmark data set of your own proprietary data.
Yeah.
And that's where I think the big firms, where I've seen really cool stuff, is firms that, call it 20, 30 years ago, basically decided this data is going to be valuable for us. One day we're just going to save it here. One day we're going to go want to reference this data set and we're going to care about it. We're going to maintain it and clean it. And so I think the most impressive stuff at the larger scale is firms that are seeing thousands and thousands of deals a month. They've saved that data set down. They actually have their own proprietary benchmarks that basically it becomes alpha, right, for decision making. Now harnessing that, I think, is the next piece, which is like, great. Like we're talking about a whole data, engineering effort here, but being able to say, great, new deal came in. We've looked at 300 deals that look similar to this. What did their metrics look like? Are they growing at the same rate? You can kind of keep extrapolating further. I think the larger firms are doing that at scale, and that's where it gets most impressive.
Just be careful of the NDA you signed and what access you have to that data after the deal's no longer there. Right.
Good point.
In a buyout scenario.
Yeah.
And again, this dinner we had last night, I asked how many people are using MCP server. Zero hands up. Right. Yeah. So I was surprised by that. Good for you though. And then two, I talked to a guy at a very large bank, and he's like, I'm not allowed to use Claude.
Yeah.
Not allowed to use OpenAI. That would shock people on Twitter.
Yes.
And shock people in Silicon Valley that massive financial institutions and some very large private equity firms are like, no. Compliance and IT have said, you cannot use these tools. Right. So then you need a third party. They're hiring you to say, hey, make sure you give me the guardrails.
Exactly.
And this is my whole SaaSpocalypse argument, which is AI will be domesticated by enterprise software. Not that AI is going to decimate enterprise software, because of the lawyers are going to get in the way, compliance is going to get in the way, and they should. In large enterprises, that's why large enterprises operate the way they do, and are consistent, because it's not. They have guardrails and rules.
Yeah, I think one of the most underrated areas right now, or underexplored, that I think is really interesting to be building, is this governance layer for financial institutions and how they interact with any foundational model. There's no company I've seen that's like cracked this to say, a massive bank wants to use Claude, and wants to use MCPs, but how do they properly interact with it so it's not completely the opposite of domesticated wild? That layer right now, I haven't seen anyone go and approach that. And I do think there are tools out there that are kind of built to harness and add more guardrails, but I think it's really early stages. But this is an interesting area.
Yeah. Well, in conversations with Morningstar guys, a year ago they thought the LMs are coming to destroy them, and the stock price would reflect that. The market thought that too. Fast forward less than a year, and it's like, oh no, they've come to cooperate with us because they need us, because we have great data, and we have a trusted brand, and we've got distribution with people trust, and you're built into the workflow. So hard to displace that. I think people have figured that out. I would imagine a lot of your prospects will say like, we're going to roll our own. When should you roll your own? How would you do it? When's it going to break? And when you should just use a third-party product?
I think that everyone should try rolling their own. That might be a contrarian take, but I think that... You're
so sneaky.
I mean, it's
because it's gonna work for a few weeks, and then somebody's gonna forget about it. They're gonna go back to the portfolio review, and then you're like, oh yeah, this thing kind of just went wild on me. Because I didn't nurture this agent or whatever it was, and it's just hard. We're not in the business of rolling our own, but I agree with you. Everybody should try and roll their own.
Well, just for the fact of, I think, interacting with the AI models today, I think everyone should try it. Everyone should try to build something. I think the barrier to entry to try to create stuff right now is such a special moment where everyone can try it. So I genuinely mean that you should try. I think that a specific metric I've tracked with our sales team is when people do try to build their own, we kind of timestamp it in our CRM. So there's something. If you're on the Lumonic team, I'm really anal about tracking very specific things around customer journeys. The average is about 9 months for them to come back to us after they've started the internal build. And
because here's my guess. Step one, hey, just take all those spreadsheets we get every month from our portfolio companies, put them in a folder, attach Claude to it, co-work to it, and then, okay, build our PowerPoint for the portfolio review.
Yeah.
That's step one.
Yeah.
Okay, that was a little clunky. Maybe step two is they get Index or Shortcut or some other AI, Excel plugin tool, which we think were, as a class, horrible 9 months ago. Now they're like, same guys on my team, same team, people on my team are like, these are getting pretty good.
Yeah.
So then maybe use that to make the data more standardized and then put that into a folder and attach Claude to it. Step two is we're going to build our own MCP server.
Yeah.
Because then we can standardize all this,
Yeah.
right? And we're just going to literally have our portfolio companies email the MCP server, CC the somewhere where the MCP server can grab it, so we don't have to touch it. Okay, well, I was in a room of 40 people last night. I think there was a few $100 billion in the room.
Yeah,
0 people building an MCP server, or knew if their firm was. To your point, that seems like a good idea. But if you're on Twitter all the time, MCP is cooked. Just let the model do the job. Why would you get in the way of it? We can have an argument whether you should do that or not. And then you've got an MCP. You'll have an MCP, way to do it. PitchBook's got an MCP server. Like, you guys can just interact with the tools through Claude your own. And then you get to the conclusion of, like, guys, well, why are we doing this? Which is every single software company you own is dealing with the same thing.
Exactly.
Which is, I don't know if it's 6 months, 9 months, 18 months. Somebody's coming back and be like, that was fun and it was hard. And either it broke, the guy who did it left, it atrophied, the agents ran wild.
Yeah.
There's no harness around this. Like, just do this for us. I'm renting you their software for a reason, so you can figure this out for me.
100%. I mean, I think the world, again, coming back to not even just Lumonic, but I think because the barrier to entry is gone now for creating software, the entire world right now is learning the software development lifecycle, which is almost the first thing you build is wrong. Almost, it's always harder to maintain it than you think. There's always all these edge cases that exist. And my unhinged view would be you could probably rebuild Lumonic and get 60, 70% of the way there on your own. I like strongly believe this. I think people are way more capable than they realize on building stuff. Why you're paying Lumonic, why you're signing up for our software is that last 25%, that last 30%, talk to any engineer on our team, talk to any product person on our team, is brutal. And it is all the edge cases. Just to give a very specific example, we ingest Excel files into our cloud-based platform, and then we do a bunch of extraction on top of it. We have all this UI on top of it. At one point, we had to go as far as to meet the Microsoft Excel team based in China to go actually into the root of how Excel was built, to go and understand, like, why can't we open these very specific file types that have these specific macros embedded into here? And our software just takes care of that, right? So, like, that's the edge case stuff that I actually think, why a lot of these systems of records or ledgers are going to exist is because they've spent a lot of time doing that. Not to mention, simple things like authentication, which is something, that takes all the fun out of building that, like, it's kind of all these layers of just stuff that is, like, actually quite hard on the edge cases that you can just use off the shelf.
Yeah, but that Excel China team edge case is, okay, 2 of your 100 portfolio companies break and nobody knows why.
Yep.
And you built it yourself, leads the CIO in that portfolio review to be like, what are we doing, guys? We don't have data for these 2 companies. It was like, well, because they're models and we don't know why. It's like, okay, this is all garbage. Why are we doing this?
Yeah.
And how much time are you wasting on this when it's not your job?
Yeah.
Like, I'm not paying you to, well, maybe somebody on the team, his job is to collect all the data, right? But, like, why are deal people sitting around a table arguing about how to, like, standardize data from a business we own 10% of the credit in, and we just want to monitor whether or not, like, we should believe these guys or not.
Yeah.
So yeah, I agree. I mean, this whole thing that everybody's going to roll their own drives me nuts.
There's a very specific type of firm that I would say should probably go and build their own, which is there are venture firms that are investing in frontier technologies that have built in-house engineering teams. And I actually think that's probably the right way to go. Hedge funds are kind of notorious for doing this, for building their own in-house technology, and it's an actual edge. I think that if you're investing in these AI companies, one, as a founder, I think that's really cool for a firm to actually be builders and actually creating things themselves. But then two, you're kind of face to face with the technologies that you're investing in. And I think in that very specific case, if you're venture and you're investing in these AI, focused companies, I think it's probably the right choice. But for everyone, 99% of
why waste
firms out there.
Why waste all that amazing talent on a reporting product? No offense.
Yeah.
No, internally.
Yeah.
No, use that to create some edge or some differentiation that you can generate alpha from, not from like automating reporting. Again, we started this conversation with, in 1997, 1998, my wife and a friend of mine were basically typing data from paper into a spreadsheet of some sort or a database of some sort. And the pressures around public-private convergence, right? It's already hard to start on the credit side.
Yeah.
Right? So not a big surprise you've had success on the credit side. It's coming for private equity.
Yeah.
PitchBook and Morningstar know better than I do about when that's coming, and LPs have a sense of when that's coming. I think of it as the co-founder of a business with $1 billion of AUM. On the very small end, I'm thinking, when do I need to be ready to provide the data that my LPs and prospective LPs will want to see, and the regulators will want to see, for me to be able to participate in this regulated industry? And if I'm just assuming it's going to be like some new 26-year-old I hire from William Blair owns the spreadsheet when the auditors come in or when the SEC shows up or whatever, and my CFO, that's a dangerous place to be, owning a business that's regulated. Yeah. It's like, no, I need to be thinking of, I now have to handle compliance requirements we've never had to at our scale, right? Our size. We used to be able to get away with it. Oh, we're the small guys. We don't need to do that anymore. Well, that ended, and it's only getting the bar. I don't say worse because I believe in compliance, and my wife was a compliance officer. I totally get it. It's getting harder and more expensive, and technology is helping us punch way above our weight. It's going to be the same thing on the reporting side. An allocator is going to say, if you want my money, you need to give me this level of transparency because I can get it from somebody else.
Right.
Oh, your returns are a little better? How do I know? Because you basically are just telling me what they are. I know for a fact that this other fund, I know their numbers, at a molecular level because they provide me full transparency at a much faster rate. And that's how we would need to run our business and our risk management. And if you can't do that, then we can't be your LP. I mean, people in private equity just live in this bubble. They think that we're protected from regulation, protected from all these things, and we just do deals. It's like that deals is just a small part of the things we do. And I think building this infrastructure is critical to survive over the next 10 years. You're going to need to have the data at a much more granular level.
100%. I mean, it's maybe a blog post that you should write because I'm a terrible writer, but it's like, what does it mean to be private, right? Looking forward. A private equity fund, a private credit fund. Like, what does it mean to be a private company? I think is like an interesting philosophical rabbit hole.
Yeah, the private in private equity is a feature, not a bug. But you're kidding yourself if you think private equity is private. I mean, maybe in the small end of it, it still is. But again, what's happening at the large end is going to trickle down. That is a great idea for a blog post. I'm going to steal it. But you could be a great writer if you just like Claude. You teach Claude how to write somebody respect, and then it can ape it. My latest piece is called "From Barbarians at the Gate to Nerds at the Terminal." It's a history of software by how private equity came to love software and then loved it too much. That's my working title.
I like it.
Really around, you couldn't lever a software business, and now you can over-lever a software business in 30 years. Yeah. Literally went from, and then obviously that's one of the challenges in private credit, no doubt. All right, let's wrap this up with a couple simple questions. What is something you'll bet your bonus on that will happen in the next 12, 24 months?
So we ran a survey recently, earlier this year, around basically the state of private credit technology. There was a bifurcation of where all the AI was getting deployed in our market. And the punchline is everything kind of pre-investment. It was just massive. It was like 2x adoption of all the frontier models, of a bunch of AI tools on the front end. It's like a frenzy. Like firms that you would have thought a year ago would have, had a ton of procurement and just weren't adopting tools, like everyone's kind of changed. And so that's, if you're on the deal team, if you're in the front office, like it's dramatically changed. What really blew my mind is that we saw little to no change on the middle to back office. So what I would bet my bonus on would be that I don't think much is going to change in terms of AI adoption. I'd say if you're looking at tooling today, is something I really like, that people shouldn't be charging you more for AI. Like, this is just, it's going to be everywhere, and it should be just part of software that you purchase. So yeah, kind of an anticlimactic answer, but I actually think in our world, not much is going to change.
At my annual meeting a few weeks ago, I had a slide that basically talking about kind of alpha on the buy. How do you differentiate yourself on the buy? And it was, and I sent it to Kunal the other day, which was, here's every private equity workflow and data tool we have demoed as a small, like we are tiny, compared to most in private equity, that we have demoed since last November. And it was the logo slide. You would think it was like the MarTech venture capital investment slide that everybody jokes about, which is like, there's so many logos, you can't keep track of them, right? I don't know, there was 40 or 50 logos on that page. And yeah, we've looked and demoed all of them, and they were all for the pre-acquisition, for pre-acquisition.
Yeah.
And some of them have gone out of business. Some of them have already changed the name. Some of them have completely pivoted. But I agree with you. We had the Accordion team on recently, the head of AI at Accordion. They're kind of financial diligence, Q of E, and kind of expanding into other things. And our whole conversation was like, how do we make finance fun again? And that's like, yeah, you automate all the tedious stuff so the finance people can actually spend more time on the fun stuff. Cass on our team at our annual meeting showed the calendar of a typical CFO in a year and how many days do you have to spend on strategic stuff that increases the enterprise value or, the opportunity to outperform. And it's not very many. When you get auditing done and financial reporting done and LP reporting done and all the stuff you have to do, you maybe have a few weeks a year to actually do the big important stuff. Yeah. So I agree with you. Do you have any contrarian bets or things that you believe that other people in the industry or even in your company aren't so sure of, given that kind of you're a founder and have big ideas and probably have taken the other side of bets and been successful?
Contrarian takes right now. I think that AI adoption, although the numbers feel really staggering and, it seems like it's everywhere, especially if you're on Twitter. When you look at the world's population, like, it's actually not that many people yet. There's a specific lecture at Stanford from the head of trading at, I'm going to forget the name of this firm. It's one of the big hedge funds. And he showed basically the adoption curves of social media platforms, and then these kind of must-use everyday apps like WhatsApp or YouTube, and then kind of more niche apps like Amazon or Spotify, and kind of three curves of adoption over a 20-year period. And then he plotted out where ChatGPT, Claude, Gemini, these models are like. And where would you guess that adoption curve is trending right now, right?
Yeah, everybody thinks that AI is straight up and the fastest thing to ever get to this level of penetration.
Yeah. It's somewhere in between the social media apps and the more niche Spotify's, Amazon's, right? And that's the adoption curve right now. And obviously this can change in a year, but I think it's a lot slower than people realize. And in highly regulated industries, I think there's still a lot of room to expand and grow. Yeah.
Well, then also let's decide what is a user versus somebody who just kind of dabbled with it. A lot of people have typed a query or used ChatGPT like a search engine.
Yeah.
Almost none.
Yeah. As
a percentage of the world population, has built an agent and let it loose on something.
Yeah. Yeah. And then that's another one. This might not be contrarian, but I'm very bullish on just human potential. I think everyone always underrates what they're capable of, and I think that we're in this period of time now where people can create and do a lot more things than they realize. In my personal network alone, it feels like a Cambrian explosion of people starting companies. It is crazy to me. In terms of the SaaS apocalypse, what I'm seeing on the ground floor and like the earliest of stages is that there's like everyone wants to build a company and everyone's actually building right now, which is one of the coolest things being a founder. I mean, it's obviously going to get really competitive, but I think you're going to see a massive increase in just net new companies getting created with the people using AI.
I think it's awesome. I think everybody should start their own private equity firm too. I'm out there on Twitter telling people like, now is the great time to do it. Why would you not do it? Go start your own firm. All right, actual closing question, which I've rarely asked, but given our conversations over the last few weeks, I think you'll be able to nail this one. And I didn't tell you what it was going to be.
Okay.
So you live in Seattle, right?
Yeah.
How long have you been in Seattle?
A little over a year.
All right. So you can either pick Seattle or San Francisco because have spent more time in San Francisco. But you have a good friend in town from out of town. Where are you going to dinner? Give me one in Seattle, one in San Francisco.
Yeah. San Francisco would probably be Chez Maman. It's a French place. Get the steak frites, get extra ketchup, have a glass of champagne. It's our date night spot in San Francisco. And then Seattle, food's not as good as it is in San Francisco, but probably say get a sandwich at Hushy's, get the lemonade, get the cookie, make sure it's hot. Yeah.
Amazing. Perfect. All right. Well, if you're in Chicago, you know I'm taking you to a VEC. An
Sounds
absolute stalwart of the West Loop and never misses. So, Kevin, I've really gotten to know you pretty well in the last couple of weeks. I appreciate you coming on. I think this is an absolute banger of an episode. Everybody's thinking about this. They're trying to figure out whether they roll their own or they go with a third party. And I think the drumbeat of convergence and transparency is coming, and the plumbing needs to catch up with it. And I think you guys are positioned to be in a great spot to do that.
Thanks for having me on.
Yeah. Bye for now.
From the heart of Chicago to all over the globe, couple private equity geniuses, they share what they know. They love to mess with technology where the future is sink or swim. It's the Private Equity Funcast with Devin and Jim. Technology issues and middle market PE-backed companies, they bicker with each other and they don't take themselves too seriously. It's not venture capital, it's private equity. It's the Private Equity Funcast. Pour yourself a drink and